Right, so we're looking at question 7, which was the budgeting question. And if we look at our required here, and we just zoom in a little bit to get that a little bit bigger. There we go. We've got the following information: 20 minutes, 12 minutes, 20 marks. That means we've got 12 minutes, so it shouldn't take us too much time. Calculate the amount of cash that will be received from debtors in December 2012. Then we've got 1 and 2 theory questions here. Indicate any non-cash items which appear in the cash budget. Right, and discuss at least 2 decisions taken by management which were not good decisions. And they give us a tip here: refer to the cash on hand at the end of December. So we'll work our way through those. And in order to do that, we're first going to calculate the cash that will be received from debtors in December. So that's in effect our debtors collection schedule that they are asking for us. Debtors collection schedule. Right, so there we go. That's what we're going to do. And this is the information we have. We've got the actual sales for October and November. So if we draw a timeline, something like this. Let's say this is October, November, and December. There we go. And it is expected that the actual sales of December is going to be 10% more than the sales of November. So we don't actually have the sales for December. So if I just move this a little bit, I just move this up a little bit there. So there's my timeline. And we are now saying the December sales is the one that we don't have. We don't necessarily need it, but we will see if we do need it. The December sales is going to be 10% more than the sales of November. The higher sales are due to it being Christmas. Okay, so that makes 100% sense. More sales in December because of Christmas time. And then 40% of all sales are on credit. So we've got our total sales and 40% of that is going to be credit. What does that mean for the remaining 60%? And that is going to be cash sales. All right, our credit terms is as follows. 50% of debtors pay within 30 days and receive a 5% discount of 5%. 48% pay within 60 days. The rest should be written off as irrecoverable. So that we're going to need in order to determine the amount received from our debtors in December 2012. So this really is a little bit unclear in the sense that, I will explain that now. Let's just see the rest of the information. Then we've got our collection from debtors for December. This is the cash budget for December. Here you can see this is the figure that they've asked us to calculate. They've got the remainder of the figures there, cash sales, etc. Okie dokie. Other expenses, don't just immediately go and calculate the amount just because it's got question marks. Look at the required and see if it is even necessary for you to calculate those items. So we know that 50% of debtors pay within 30 days and receive a discount of 5%. So the sales that I made in November is going to be paid within 30 days and will probably only be received in December. Now this is where the interpretation or the assumption that you make may differ. For example, if I made a sale on the 1st of November, chances are very good. There I go, I make my sale on the 1st of November. Chances are very good that I receive this money somewhere in November because I receive it within 30 days. If I make the sale on the 30th of November, here we go, I make the sale on the 30th, chances are very good I'm going to receive it in December. So a more clear way to have put this would have been to say 50% of debtors pay within 1 month after the month of sale. That would have given us a clearer indication. as to exactly which month we will receive the cash from the debtors. Right now it's a little bit open to interpretation, but and I've seen it being interpreted in either way in different exam questions. So best would be to state your assumption in the question very clearly and to say that you assume that most of the sales are made near the end of November, and therefore most of the November sales collected within 30 days would be collected in December. Alright, so now we can start answering this question. If we go to our solution, or our answer book rather, we know that of this 810 total sales, 40% of these sales is credit sales, so we need to work out 40% of this, and then we know 50% of this is going to be collected within December. So 50% of this 40% will be collected in December, and 48% of it will only be collected in January. Right, so here we go. We've got November sales. November credit sales specifically is 810,000. That's the total sales. We multiply this by 40% to get the credit sales. Then of this amount that we get, we're going to still further, maybe let's just move it to a new line. Let's just move that one quickly. And let's just move it there. 810 times 40%, that gives us the credit sales. Of this amount, 50% of that will be paid within 30 days, and we assume sales, credit sales are made near the end of the month, and will thus, you need to make sure that whenever you make an assumption, it is actually a valid assumption. But here, because there was a little bit of this or ambiguity, you could make an assumption, assume that the credit sales are made near the end of the month and will thus only be received in the next month. So if they say it's received within 30 days, we're assuming that those 30 days will not fall within that specific month or the same month, but it will fall in the month after the month of the sale. So in the next month, in the month, you can say in the month after the month of sale. Okay, so that is our interpretation. 810,000 times 0.4, and that gives us the credit sales for November, and 50% of that will be received in December after allowing for a 5% discount. So 50% of it will be received in December, but we need to reduce this by a 5% discount, so we can do that easily by multiplying by 95 over 100, or we could simply say multiply by 0.95, and that will work in the discount. So if I calculate that with my calculator, and we're going to get, let's move it there, 810 times 0.4 times 0.5 times 0.95, and that is 153,900. That will be collected in December. Alright, so we've dealt with the November sales that will be collected in December. Okay, that is the first one. 50% of that, of the November sales, will be collected in December. What about the October sales? How much of the October sales will be collected in December? Well, the October month is 2 months before December, and they say 48% of debtors pay within 60 days. Alright, so again we're assuming that if we made sales in October, we're assuming most of it occurs near the end of October. So if debtors pay us within 60 days, most of this is going to be collected only in December. Okay, so there's 30 days would be around here, so 60 days would be around here. So the bulk of that would be collected in December. That's our assumption. Again, a more clear way for the question to have been asked is to say that 48% of debtors pay within 2 months after the month of sale. Okay, there we go. So first thing for us to do is to work out the credit sales of the 700,000, and again that's going to be 40% of the 700,000 is credit sales. October credit sales is going to be 700,000 Rand times 40%, and of that amount we're going to collect 48% within 60 days, in other words 2 months later, which would be 2 in December. So 48% of this will be collected in December. So we grab our calculator quickly. 700,000 times 0.4 times 0.48, 134, 400. We can then go and check if that is all the money we will receive from our creditors. We're not given any information about September. We're also not told anything about any months more than 2 months before the collection month. So all we know is that the rest should be written off, so we won't collect that in any case. And we also know that the December sales would most probably only be collected in January, so we're not going to do anything with the December sales. So this information about the December sales being 10% more than the November sales is really not relevant for us. If you did calculate that, it would have come to 810,000 multiplied by 1.1. That's going to give you the December sales, and that would be 891,000. So that would have been the December sales, but we didn't need that because the December sales would in all likelihood only be collected in January, based on our assumption here that we said assume credit sales are made near the end of the month and will thus only be received in the month after the month of the sale. Right, so if we add this together, we're going to get our total of 288,300, and that is the amount collected from debtors in December. That was fairly easy, 8 marks. Indicate any, question 2, indicate any non-cash items which appear in the cash budget. So non-cash items is items that should actually not be in the cash budget, because the cash budget should really only deal with cash receipts or cash payments. Okay, if it's a non-cash item, it may be an income or an expense, but it might not be a cash income or a cash expense. So let's have a look. Cash sales, that's cash. Collection of debtors, that's cash. Rent income, that will in all likelihood be cash. Interest on fixed deposit, cash. Increase in long-term loan, we'll get the money from the bank, that'll be cash. Selling of equipment, that's going to be cash. The profit with the disposal of equipment, this is not a cash item. The cash item is this selling of the equipment, where we've got the proceeds. This profit will actually be included within the proceeds. So this is a non-cash item, so there's one. Right, inventory purchases, that's going to be a cash item. Rent expense, cash item. Bad debts, all right, you simply write off the amount that is owed to you. You don't pay anything. You simply say, well, the debtors owe me less, so that's also a non-cash item. Salaries, that's a cash item. Bonuses, cash. Other expenses that we pay, that's going to be cash. Fixed deposit that we pay, that's going to be cash. Interest on a long-term loan that we pay, that's going to be cash. Depreciation. All right, remember from the cash flow statement, we also added back depreciation because it is a non-cash item. All right, in the same year, this should not be in my cash budget because depreciation is not a cash expense. You're not paying money for depreciation. It's because you used an asset, a computer or a vehicle, etc. Because you use that asset, there's an expense in your books, and the asset is going down and your expense is increasing. But the asset that's going down is not bank, so it's not cash. It is in fact the vehicle via accumulated depreciation on vehicle or accumulated depreciation on computer, etc. Right, the deposit on the delivery vehicle, that would be a payment in cash. Cash drawings, that would be a cash effect because you're taking cash, so cash would be leaving the business. Inventory drawings, there is no movement of cash. So the question you need to ask yourself, did that item cause any movement in cash? All of the ticks is yes, but inventory drawings is when the owner takes inventory, trading stock, not taking cash as in this one, but they're taking inventory. So again, no cash movement here, so it'll also be a non-cash item. So any of those four would have been non-cash items, and you can put them down here. Right, the last one, discuss at least 2 decisions taken by management which are not good decisions. Okay, so in other words, they are bad decisions. Refer to the cash on hand at the end of December. Let's have a look. The cash on hand at the end of December. Here we go. At the beginning of the month, there was a mere 65,000 Rand. At the end of the month, there's almost 363,000. So that's almost a 300 Rand increase. Here we can see 300 Rand increase during December. Now, that's a lot of surplus cash, and surplus cash is not always the best investment. The return that you get on a cash or savings or check account is really minimal, and you hardly beat inflation. So having money lying around as cash is not always your best investment. So that's one point you could have said. You could have said that there may be alternative investments that they could have placed this money into. They could have increased the fixed deposit. They could have paid off some of their loan. Let's see what happened here at the top. If they had a loan, they definitely had a loan because he has interest on the loan amount, 11%, so they could have paid that off. That would have been a wise idea because the interest earned on the fixed deposit is mere 8%, okay? And this is the interest that is income for the business, and this is the interest that is an expense for the business. So you can see the interest expense is 11%, which is more than the 8%. So it would be wise to reduce your expenses rather than to try and increase your interest income. It's probably going to be better to pay off your loan. All right, so that's one thing they could have done. They could have paid off. I'm just going to put abbreviated form here, pay off the loan, because interest on the loan is greater than the interest on the fixed deposit. And the second thing they could have done is they could have found a better investment for the cash than just lying around. Invest the surplus cash rather than have it lie around. Invest surplus cash, right? That's another thing they could have done. The third thing they could have done, yeah, we see why on earth did they increase the long-term loan if they already had so much cash lying around. There's absolutely no need for them to have increased the long-term loan. So that's another thing they could have done. All right.